We're going from a period of exceptional growth in the U.S. economy. So 4% earlier in the year or earlier in last year was an unsustainable rate, going down to 3% and probably down to trend this year, which we'd estimate is 1.5% to 2%. I think what's spooking markets is that you have a bit of a signal extraction problem when you have any sharp deceleration in growth. So is this just going back to trend, something more benign in nature for markets, or is it the end of the cycle? We're not going to know that if all we're observing is a sharp deceleration. So I think all of this suggests it's very difficult for risk assets to do well in a multi-asset portfolio.
You're negative. You're underweight equities
at the moment,
and overweight cash, right? And bond, huh?
Right now.
For how long? Well, how long could this be?
I think it's important to be cautious at the moment as we navigate that late cycle deceleration that we're in right now. I think it's also important not to get too negative. In other words, we're reserving the right to be a little bit more optimistic in, say, 6 months' time or 9 months' time, when the deceleration is in the rearview mirror, when peak earnings growth narratives are in the past, and with any luck, you get a little bit of relief from the Fed and from the trade war.
Gary, I read your comments, and I mean, you're a successful guy. You've got a good career and everything, but you were not considered for Fed chair, were you? Do you know, was your name in the, it was not put in the ring, right?
Joe, it's always been a goal of mine.
It's always been a goal?
Okay.
But how come,
court,
how come you could figure it out? That maybe what you should say after every increase is, it made sense now, but we don't know if it's going to make sense in the future. Why is that so hard to say that? Why? And you came up with it. Maybe you're in the running now in my book.
So as the Fed gets closer to neutral, conducting monetary policy becomes more challenging, not only for the decision itself, but also in terms of market guidance and market.
How do you know we're not at neutral now?
I think maybe we should be at neutral now. In fact, what I'd like to see Jay Powell do is say, tell us that we're at neutral, or at least we're getting.
He doesn't believe we're at
neutral.
He has some reason to think that we're
close.
Yeah, we're in the range of neutral.
Well, in October he said we're like a million miles from neutral.
He's changed his mind.
And then since then, he said we're basically at the bottom edge of neutral.
Yeah.
Well, and he's
We're
speaking
close to the
today.
bottom edge.
Yeah.
He's speaking today in Atlanta, and I'm hoping to hear those words that we're getting very close to neutral, because that'll take a lot of fear out of the marketplace.
But can I also say, if we do get a strong number, or let's say slightly better than expected number, and wages are fine as expected, or maybe even better, isn't there the opening right now, given what financial markets have done, for Powell to also say, yes, we see the numbers, but we're going to be data dependent from here on out. Financial conditions have done some of our work for us. So in other words, a strong number isn't necessarily a tightening panic.
That is correct, because the numbers back in December, Joe, you said that. It's last month's employment number. Markets are always looking forward. So just because it's a strong number today doesn't necessarily mean that the Fed tightens.
That's all they ever use, though. That's why they always overshoot, right? That's why every recession has been really from
the Fed is reactive, not proactive.
Reactive.
Yes.
And the master of the universe, Alan Greenspan, remember what he was the most powerful man in the world. Bernanke, most powerful man in the world. And shouldn't, in that position, shouldn't they have some feel for what the future is like instead of just reacting to the past?
The Fed is a big institution, Joe. They have their own rules on how they go forward.
But they don't have rules. John Taylor wanted them to have rules. They have no rules. They fly by the seat of their pants all the time.
Joe, there are over 70 people at an FOMC meeting. 17 people are members of the FOMC, 12 are voting members at any point in time, and the Fed chair is there to come up with a consensus.
You know a lot.
It's a lot of people.
Maybe you were in the running. You know a lot. How much? 70 and then 12? Okay.
Yeah.
But could I ask you something? I mean, is equity volatility...
No, I ask you. You can't. Ask me. I don't have any. Believe me, I have no answers. I know that.
But should the Fed care about equity volatility per se?
If it's a leading indicator, if they put that... If there's a reason in the LEI that the stock market is such a big component of the LEI, that's not something that they should use in their toolkit. They should just look at lagging indicators.
I think what they'd be more concerned about, frankly, is the fact that the yield curve is telling them something about the state of the economy.
Okay, the yield curve. That didn't help either.
They're looking at the future. They're worried about that big growth slowdown that will eventually end the cycle, in which, to be frank, they don't have a flawless history of preventing in the past. And we're looking at the yield curve now, which has inverted and is actually pricing in cuts a year out. And so I think, one thing to consider as we think about that Fed pricing, is that the Fed itself has been very clear about slowing down this year as it approaches neutral, but the market has gone way further than that and is pricing cuts a year out. And so I think there's a high bar for the Fed just to be more dovish relative to those expectations.
To me, they have a dual mandate, and people don't, they don't even like that. Maybe they need another one. I wish they only had one.
We used to say they should only have one.
I know, but now they're violating both. They're doing
unemployment.
You want full employment, so you leave rates to stay low, and you want to make sure that there's no inflation, but there isn't really any inflation.
That's an argument for never.
But there is
raising
inflation.
rates.
I mean, inflation has trended slightly higher. Over the time, we've gone from 0 to 2.25.
Like in Japan, where rates are 0. Like in Germany, where rates are 15 basis points.
It's not no inflation. It's contained inflation. Very close.
How do we know
that
Apple and Microsoft and Google and Amazon, how do you know that inflation basically is going to be low for a long time because of the internet? Because Paul Krugman is wrong.
Jay Powell had, at Jackson Hole, acknowledged that possibility that you're going to see this kind of different effect.
And
scientific
gains are coming quicker and quicker and quicker, and it all adds to productivity and holding prices down. You got China exporting cheap things still for a while, unless it's tariffs. I don't know.
And that's why you have a very flat yield curve.
Yeah. Is that why?
That's right, because the long end of the yield curve always responds to fundamentals of the economy and inflation. Inflation is relatively stable, relatively low, so yields don't have to rise. The short end responds to Fed monetary policy, which is a little hot right now, and it's causing short rates to rise. So these come down, this goes up, and it's flat.